Happy Super Bowl Sunday. Pretty early in the morning here on Sunday, and I figured I'd get this out because nobody really cares about what's going on in the stock market because it's Super Bowl Sunday. And all anybody wants to do is get drunk, lay on their couch. Why you would have the remote control in your hand makes absolutely no sense because all you're going to do is either watch the game or you're going to watch the game for the commercials. So, Super Bowl Sunday. Have fun, enjoy it. Why am I getting these pop ups? But yeah, we're going to keep this really quick because we got CPI on Tuesday, and everybody saw the news already of what happened this weekend right after the closing bell on Friday, late Friday night. Here you go.
Flying saucers have invaded our planet. Washington, London, Paris, Moscow are key targets. The whole world is under attack. Can it survive?
So, yeah, there's a lot going on that it's all there to distract you. Anyway, last week, down week, red week, SPX closed down 29 points below the Monday open. You had an 87-point run, 92-point run, and again, the red week that we had, which was OPEX in January, was only down 26 points. We were up 88 points the second week of January, 41 points the first week, down 4 points, down 9 points those last 2 weeks in December when we were looking for that Santa Claus rally, and why we were so bullish heading into the start of the year. And I tell you, one of the other things I'm looking at here is from a monthly, just for the month, the SPX has been green January and February since the 5th of January, the third trading session of the year. When we started here in February, we started at 40.70. We had that dip right there in the very first day, but it's a 111-point run. And if I recall why on February 1? Oh, it was the FOMC meeting. There you go. So spreads are killing it, man. There was that miscommunication and misunderstanding when the easy bearish calls trade on Thursday got taken on to when I post risky 100 times in the chat room. I'm trying to get a point across. 48.88 was the edge, dipped down below that, closed below that. Again, no catalyst, rare. Third time I've seen that happen in 6 months for no reason whatsoever, but I was throwing it out there in the chat room 100 times. This is risky, this is risky, this is risky. But as you can see here, I mean, we've been playing the bearish calls for a good portion of 3 weeks. And because of where we landed there on Thursday and the way that we kind of look, because I'm going to give some respect here that the full moon happened on Sunday. So you've got your full moon, call it Monday. That 40.60 that we dropped down to, I'm just going to let this sit for a day or two and let's get that CPI out of the way because, look, English is my first language, but I don't understand this shit. This doesn't make any sense to me whatsoever. U.S. Bureau of Labor and Statistics. Beginning with January 2023 data, which is the report that we get on Tuesday, blah, 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 they're going to have a different form of weight for the CPI when it comes to rent. Another one is starting January 2023, BLS plans to update weights annually for the CPI based on single calendar year of data using consumer expenditure data from 2021. This reflects a change from prior practice of updating weights biennially using 2 years of expenditure data. Again, I know charts, I know price points, I know how to look at a price of an option and say that's a bargain, it's worth taking, that's a bargain, it's worth selling. This shit here, I got no fucking idea what they're talking about. All I know is that they're trying to say the report's going to be shitty, but it's going to look better because we're using a different way of calculating it. So, six of one, half a dozen the other. I don't want to be involved with CPI, and here's why. Here is January CPI, or which was the December CPI. We gapped down or opened flat, whatever it may be, had the little drop down, and then boom, right back up, closed basically flat on the day in January. In December, big gap up, sold right off. If I recall, that was when we hit 4,100. And yep, that was the day we hit 4,100 for the second time in December, which was the easiest short you could possibly have gotten into prior to the other 4,100 short that we got into in the beginning of the month in December. November, plus 5% day on the SPX, massive gap up, sideways to the upside. NASDAQ, 7% day. Again, here's your October where we hit our October lows on this day. On this day, we hit our October lows. And right at the opening bell, when we were extremely bullish, this blew everybody out of the water. Plus 92 points on the day, plus 2% day. Massive, incredible run. I think it was 180, 190 point range on the SPX. And then you got September, which was our big gap down, and that whole collapse that we had taking place. Massive gap down, and then just teetering off, heading all the way down there to 39.32, which basically started around where we are right now at 4,100, opening around 40.40 where we closed on Friday. So, nothing really spectacular to go out there and be incredibly aggressive that this is definitely the trade to be taking come Monday morning. It's just, it's a bunch of mashed potatoes with week old gravy on top of it because we didn't do anything. Here was our week on QQQ. Flat Monday, Tuesday, the spike up when Jerome Powell spoke, come right back down. Again, do absolutely nothing, and then slowly fade down below that 300 and close right at 300, 299.70. Still above the 20-day moving average. 200-day moving average sitting flushly below that 292. The 50-day moving average is climbing, and you've got this old trend line from the highs from way back in 2022, the April and the August highs, down here at 284. I'm still looking for 286 during the course of this month in February, but as of right here, right now, nothing that I want to jump into, and I'll show you why in a second. Here, SPY, same time frame. I was trying to get a little creative with, okay, where are we as far as our drops? Drew a little Fibonacci. We came right down to where our number 2 spot was on SPX at 40.65. We came right on down to it on Friday. Had our little bounce, fade up. I mean, this is very clearly a bear flag. There's no question about it. But you're right back here at what was your support. And now we're here at basically a faded off Friday resistance area. 50-day crossed over the 200 prior to the start of the week. 200 is fading, 50 is climbing. Here's your old trend line again from January and March in 2022. And for me, I still expect we'll be down here at 395, 390, 395 at some point during the course of this month. But you had no choice but to take off those trades on Thursday when we had that drop because you had the VIX spike up here above that 2102. That's my first and foremost spot, having seen us being down there, down below 1811. We got 2102. I'm out. I'm done. I'm out. And that was a smart move to trade because obviously Friday they would have gone against you in the other direction. But looking here on the ES, okay, looking at the futures, I'm looking here at the 4 hour, and this was the major catalyst as to why I had to get out of that trade was because we oversold on the 4 hour chart. 4 hour is just way too big of a time frame for me to mess around with and say, yeah, we're going to continue to stay short on this. 2018, a little bit cleaner. Again, same thing here on the NASDAQ. The 4 hour oversold, don't have a choice. Got to get out of the short position, even though definitely not something to go jumping into a bullish position. And again, here, come over onto the 1 hour chart. And as we were fading down here into these lows on Friday, you could already see we had a buy divergence that was set up from prior in the week and Wednesday. So again, more warning signs as to why got to take that trade off on the short side and just kind of let this thing settle itself down. On the NQ, I've noted out here two gray areas of concern. And right here, we're just back over here to the January high pop. We're still above that big FOMC spike candle. So, for here, I'd love to see this be a little bit of a weak recovery, kind of head back up to around that 12,500 area, and then get our next fade off down to the downside. Our downside move, the first move, will be right around here, which is just above the 200-day moving average, which when you come over onto the QQQ, again, looking for a move down here right around that 290 area. That's where the next move to the downside should come over and try and test. And if we fail that, it's very clear. Going right down to the 50-day only because that's right where that price point is, that minus 30% from the all-time highs, which is your 286. Where is it? Wrong way. Right down here, 286. And that's why my 286 is my target over on the QQQ. So again, here on the NQ on the 1 hour, you had that little bit of a buy divergence set up, had that price point, had the 4 hour, everything just said, you know what, take the trade off, let this go and fade to the upside if it wants to. On the SPX, or I'm sorry, on the ES, on the S&P futures, on the 1 hour, that was a much more aggressive move to the upside. So there is a potential that we could get ourselves a overbought setting as we head into the CPI report, or at least into Monday afternoon, where on Monday afternoon, we might be able to go and take ourselves a very small trade looking for a CPI miss, because there's a lot of chatter out there that there's going to be a big miss on CPI, and that will be the catalyst to move us to the downside. As for this week being OPEX, options expiration week, there's no real big numbers out there, but the one that I do see is over here at 4,000. You've got 83,500 on the calls. You got 83,800 over here on the puts. So I don't know if this is a strangle. I don't know if this is somebody who bought the calls, sold the puts, bought the puts, sold the calls. Have absolutely no idea what this trade was on the 4,000 puts, but there's obviously, this is where your gravity is right here at 4,000. So that in and of itself is somewhat of an indicator as to where we can be looking, which is just fractionally lower than where we already are, but that will start to lubricate the downside movement so that we can start looking for that low 3,900 area. Options volume, open interest, nothing really here. Again, nothing spectacular that's sticking out, unlike over in March where you've got the JPM collar. There's nothing really out there that's screaming. And because we've been moving so small, the expected move here on Monday is fractional. They're looking for a 40-point move. So going into the close on Friday, the low of the day on Friday was 40.60. 40.65 is our big pivot. Now, again, just out of curiosity, coming over here and looking, and the 40.65 puts, 1,700 volume, 6,000 volume on the 40.60s. There's no open interest. You can see, obviously, there's a lot greater open interest now because of the volume that was there on Friday. But over here on the volume on the call side, it's 4 times. over here on 4,100. So the Bulls are still in it. They didn't smack everybody out of this and tell them, go home. It wasn't Vince Carter at the slam dunk competition, 15 years ago. It's what we have and it's what we are. And again, not expecting anything to go flaring up on Monday. And when we come into Tuesday, we'll already have our CPI report. It can be a lot more of an advantage to wait for Tuesday and then see where we go. So, yeah, Monday, we take it what it is. It's Sunday, Super Bowl hangover Monday. Typically in the past years, it's a really slow day, but not going to take anything for granted. It is Monday. It is a trading session. We'll see what we have when we come into it. But yeah, flying saucers. The good thing is at least 2023 is an alien invasion. It's not a zombie apocalypse. They'll leave the zombie apocalypse for next year. So enjoy the Super Bowl. Have fun. Have a beer for me. And hey, go look at that old stat, man. The years when Philadelphia would win the World Series, major financial catastrophes would take place in the stock market or in the global economies, really. But major financial catastrophes took place when the Philadelphia team won the World Series. Now, Philadelphia Eagles won the Super Bowl in 2018. S&P wound up closing down for the year. So nothing fantastic, nothing spectacular, but go Chiefs. Have a good day.